This is just theory, question 17. Theory-wise, they're looking at ordinary shares is not correct. Okay, so A, shareholders receive return on investment before other investor groups. Other investor groups. That's not...
So is this, sorry, can you just see this code? So I'm just getting on the
Yeah, so there's preference shareholders and there's ordinary shareholders. Here they just said shareholders, so we don't know if this is preference or ordinary, because you get two types of shareholders. They are the most risky form of investment. They carry a variable rate of dividends. They entitle the shareholder to part ownership. Okay, so the ones that are correct, they entitle the shareholder to part ownership, definitely. They carry a variable rate of dividends. Well, yes, because it would depend on whether or not you've made a profit and how much you actually pay out. And then number B, they are the most risky form of investment. That one is a bit questionable. You could motivate yes and no for that. Which statement about ordinary shares is not correct. Okay, if it's ordinary shareholders don't always receive the return before other investor groups because they are preference shareholders. So yeah, I do agree with A as well, because of other preference shareholders, potentially. Okay, so that's something to consider. 18. 18 was, okay, theory again. An investor owns 10,000 pref shares in H. 1 year H does not have enough profits to pay dividends. Okay, so if they're preference shareholders, remember preference shareholders mean what? Preference shares get paid out dividends before ordinary shareholders, and it's a percentage of their capital. Right, here they said does not have enough profit, so they didn't have profit. So if there's no profit, you can't obviously pay dividends. But the investor expects the profit to improve, and he thinks the directors will pay the outstanding dividend in the following year. Okay, so which type of shares does the investor own? Cumulative, non-cumulative, participating, redeemable? Yeah, I agree with cumulative. Why? Because cumulative means it adds up. So if you can't pay 1 year, you'll pay out the next year. So that's correct. That's just the type of share. That's just theory. Okay, so cumulative means, it's just the word cumulative means add together. Add together, pay later, basically. Right, why? Loss in this year. Okay, here's 19 theory. Let's have a look. No, 19 is working. So 19 says the issued ordinary share capital of a company at the beginning of the period was 240,000. Nominal value 60 cents. Okay, so this is ordinary shares. So we start at the beginning. Ordinary shares, bracket. They said this was beginning of the period, BOY. Okay, so the beginning was 240. That was at 60 cents a share, 0.6 per share. Okay, so if it's 60 cents per share, we can work out the number of shares. Let's quickly do that. 240 divided by 0.6 is 400,000 shares. Okay, then I read the next bit and they say a rights issue of 1 share for every 5 held. Actually, you didn't highlight that. I would highlight because that's the rights issue. So 1 share issued for every 5 held. Okay, that tells you how you're going to be issuing more equity. Was made during the period at a price of 90 cents. So at 0.90 per share. At the time, the market price was R1.10 per share. Okay, so just a note, this is a side note, market price was R1.10. Okay, then they said, what was the issued ordinary share capital after the rights issue? Okay, so that's not too bad. We look at what was it before and what was it after. Okay, I already know what it was before. You had 240,000 equity at 60 cents a share. That's 400,000 shares. Then you issued 1 for every 5 held. So issued brackets, or let's say rights issue. Okay, what is the rights issue? We need to work it out. So we've got 400,000 shares currently. We're going to give 1, so times 1 divided by 5 because it's 1 for 5 held. Okay, so let's see, times 1 divided by 5 is 80,000 shares. That's the additional shares that you're going to be issuing. Okay, they wanted the rand value or the dollar value. What is the issued ordinary share capital after the rights issue? Okay, that was the market price, and that was issued at a price of, okay, so the rights issue was issued at 90 cents. Okay, so that was at 90 cents. At 90 cents. Okay, so let's add up. So that's 0.6, and that's 400,000 shares. So total book value of equity is, okay, the 400,000 shares at 60 cents. Add the rights issue of brackets 80,000 shares at 90 cents. And then just work that out and add them up. So 400 times 60 is that. 80 times 90 cents is that. So
are these two sentences part of this?
No, that was 18.
Oh, sorry.
And then that's 19. Okay, so 19 is looking at how much equity did we have at the end. So 240 plus 720. So I'm looking for an answer of 312. That's correct. Okay. Right, the market value is the market value. That's separate.
They said the answer's A.
They went with A, 280. Nominal value is 60 and 90 cents. What is the issued ordinary share capital after the rights issue? The rights issue of 1 share for every 5 held was made during the period at a price of. I would query that. Asterisk this one. Okay. It says at a price, so you issued it at a price of 90. So it's 80,000 times 90 cents. And then this was 400,000 shares. 400,000 shares times 1 over 5, which is 80,000 shares. Yeah, that one's not right. I don't agree with the answer. That's the answer. Okay, that you can query. Okay, market value is unrelated because market value is the value of the shares in the market, not the book value of the equity that you're issuing. Because this is a rights issue. So the rights issue depends on how much you have currently in the business. Okay, because that was rights issue of 1 share for every 5 held. So we had 240,000 shares. 240,000. That's dollars. Yeah, dollars. $240,000. At 60 cents per share. So that's the total of 400,000 shares. So I first worked out the number of shares, then I worked out the value. Okay, if you want me to give you a reference for this in the textbook, so that we can query this. Okay, ordinary share capital, I'll show it to you. Let's see, PQRO, no, MNO. There, ordinary shares, 245. Okay, they want the rights issue actually, so let's rather find that. It should be there as well, but let's just see rights issue. Do they have a reference? Recording retained earnings. Rights issue there, 252. Okay, so it's 252. That's the better reference, rights issue. 252, here's 252. Okay, 252, let's see if we can find a similar example. Okay, here's one. Okay, so on page 252, they talk about the rights issue. Here they say the company made a rights issue of 1 new share for every 4 held at a price of 125. Okay, so we can go to this one as well, just to show you that it is correct. Okay, so in this example, in the textbook, ordinary shares are 50 cents each. Okay, and that was a value, a rand value of $2.5 million. Okay, why don't you take that down and we can look at this one. Your 80,000 shares was the amount of equity that we had to issue because of the 145. One share for every 5 held. Okay, so just to show that here, just to copy paste that, just to quickly revise, theory, page 252, rights issue. Okay, so the equity that they had, equity that is currently in the business. Okay, that you read out of the question, and we can see it here. Ordinary shares 50 cents. Rand or dollar value, 2.5 million. So 2.5 million, that's dollars. Okay, so let's just put a dollar sign there. In this question, it was 50 cents, 0.50 per share. Right, so same thing again, if I want to know the number of shares, so number of shares, if I know what the price is and I know what the value is, then I can work out the number of shares. This divided by the price, 0.5. Okay, 5 million shares.
Sorry, can you please put the working of what you did there on the side? So that
5 million shares. This was 2.5 million divided by the price.
0.50.
Okay, and then what did this question say? This question said the company made a rights issue of 1 new share for every 4 shares held. Okay, so in that example, 1 share issued. Rights issue for every 4 held. Okay, so how many shares did I hold? Well, there's the answer, 5 million. So if it's 1 for every 4, we need to work it out. So the working for that would be 5 million shares times 1 over 4. 5 times 1, okay, well, times 1 divided by 4, so just divide by 4. 1.25 million shares issued in the rights issue. Rights issue. Okay, then they say, where is it? Yeah, here. Already held at a price of $1.25. All shareholders took up their right and monies were paid out. Okay, if you look at this, there's the ordinary shares of 1.5. Here they split into share premium because the shares are worth 0.15. Okay, so the share premium is for that additional value of the equity. Okay, so this is looking at the statement after, see, here, redraft the statement of financial position. Okay, we're not redrafting the financial statements. G owns 500 ordinary shares after the rights issue has been completed. Calculate. Okay, so maybe this wasn't the best example because they looked at a specific owner. They just said look at the 500 ordinary shares. So 500 ordinary shares of A. Okay, so A we had to calculate the rights issue for A when they looked at the total number of shares owned by G. Sorry, I said A. Well, A is the company, Ardell PLC. Gahir is the shareholder. Okay, and the price paid by Gahir for his new shares. Okay, so maybe not the best example, but the basics apply. Let's just see if we can still apply the contents. Okay, maybe we can because they do show the split. See, they show ordinary shares at 50 cents each, which is now 3.125 million. Okay, so let's add, well, let's calculate actually. So this was the shares that I've issued. Do you agree? Okay, so let's calculate the value of those shares. Okay, so we know how many we issued. We issued 1.25 million more shares based on the 1 for every 4. Okay, we had 5 million shares issued, so then we just needed to calculate the additional shares. And they wanted you to split it in terms of the share premium. Share premium means the price at which it was issued, so more than what it costs. Okay, because the shares cost 50 cents. Okay, the rights issue already held at a price of $1.25. $1.25 is saying the rights issue had already been taken into consideration. Okay, so how many shares are you issuing? 121.25 million shares. Okay, so times 0.50 cents per share is what? Let's see what the dollar value is. Okay, let's highlight that in a different color. Okay, so this is how much the dollar value of the share is worth. Nominal value. Because we're looking at the 50 cents as the base value of the shares, because that's what the shares are worth. Okay, so let's work that out. This 1.25 million times 50 cents, 0.5 is $625. And that's the amount of dollars we had at the beginning. So after the rights issue, okay, how much are you going to have? The sum. This plus that gives you what they've got in the textbook. The textbook's correct. Okay, 13125. Okay, that's how you process the rights issue. Okay, so with this one, they haven't looked at the, or maybe they looked at the premium separately. Let's go back to the question. Okay, because you're not supposed to take the share premium into consideration. So let's try to work it out to see if it's possible to get A. Okay, so let's assume, but see, the question said it was issued at 90 cents. See, that's the problem I have with the question. They tell you in the question, 1 share for every 5 held during the period at the price of 90 cents. Okay, if they cross that out, then we can assume that the share price was also 60 cents. Okay, so let's see if we can get A using that method. So let's go back to our working. Okay, so here's the working. We were looking for that answer, which I circled C. So that's correct as it stands. Okay, let's just put a note here. Okay, if we ignore this 90 cents, which is what the shares were actually issued for, and we just use the nominal value of 60 cents. So if we use 0.60, then let's see what we get. So then, what would the value be worth? Okay, so now I'm not going to use 90 cents. I'm going to use 60 cents. That's all. I'm just using the nominal value instead of the actual value that they said in the question. Okay, so what is 80,000 shares? Because remember, 80,000 shares were the share that we issued. Okay, we wrote it down. 1 share for every 5 held. So 80,000 times 0.60. Okay, 80,000 times 0.60 gives you 48,000. Okay, then if I add, okay, then see, then you can get A, but that A is not correct. Okay, A isn't correct. So yes, okay, are those actual answers from Cambridge or just answers someone else had created?
No, Cambridge International.
Okay, so then they need to change their question and they shouldn't have said that the rights issue was at a price of 90 cents. Because it clearly says in the question, a rights issue of 1 share for every 5 held was made during the period at a price of 90 cents per share. Yeah, unless I'm not reading that correctly, it says 90 cents per share. Okay, that's what you issued those shares at. So the new equity would have been 312. Okay, it's 2288 if you only look at nominal value. Okay, but then they should have specified that they only wanted nominal value. Right, so I agree with option A, but then option A is correct only if you are looking at the nominal value of 60 cents a share, not what they said in the question. Okay, so that's one.
In 2014, a company was entirely financed by its equity and reserves, which totaled 1 million. Its return on capital employed was 28%. On the 1st of January 2015, the company issued a 10% debenture of 300,000. During 2015, the profit from operations increased by 20%. No dividends were paid. What was the return on capital employed for 2015?
Okay, thoughts?
You just have to work out return on capital.
Exactly. Okay, good. So exam technique is right. Return on capital employed is a formula. It's on page, what page number is this? 273. ROCE equals profit for the year before interest and tax divide by capital employed times 100, obviously, because it's a percentage. Okay, so we need those two considerations: the profit before interest and tax, because that's what the formula wants, and the capital employed. Okay, capital employed, we need a formula for that. That's on page 272. This was on page 273. Okay, so page 272 to 273. Capital employed can be one of two things: total assets minus current liabilities, or issued equity plus reserves plus long-term capital. Right, so let's look at the question again and see what they gave you, because then we'll know which one to use. It's a bit cold, yeah, the aircon.
Okay, what do you
go back to the question, let's see what they gave us so we know which one to use. Okay, in 2014 a company was, what did that word? Oh, entirely, so I'm reading it backwards. Entirely financed by its equity and reserves, which total 1 million. Okay, so let's write that down so we have the information. We can do a working for it. Okay, so in 2014, they tell you that equity and reserves equal 1 million. Okay, then they go on and they say its return on capital employed was 28%. Okay, so in 2014, ROCE, return on capital employed, given 28%. Okay, given in the question. Okay, then they give you a bit of information. On 1st January 2015, the company issued a 10% debenture of 300,000. So debentures is loans, it's liabilities, it's additional financing in the form of a loan. Okay, so in 2015, issued debentures, and that was 10% debentures worth, I'm just writing down what's in the question. You've highlighted it, so it's fine, so that's good. So then we have the info. Okay, what else? During 2015, the profit from the operations increased. Okay, so notice they don't give you specific values for 2015, but they've given you changes. So in 2015, profits, was it before tax or before interest? What is it? They just said profit from operations. Okay, so profit from operations. In brackets, asterisks, you would assume before interest and tax. Okay, how much was that? 20% increase. Okay, we need to actually work it out. Okay, what was the return on capital employed in 2015? Okay, that's not too bad. Right, so all you have to do, well, you know what the ROCE was in 2018. Can you work out the profit from 2014? Yes. Okay, so let's highlight that information. Well, let's put in green. Okay, obviously, I don't have anything about 2015 in terms of actual values. What's the formula? I wrote it down. There's the formula. 2015, I don't know the profit for the year. I don't know the capital employed. So I can't start here.
How do you work out capital employed? What is the formula for capital employed?
Page 272, total assets less current liabilities, or issued equity capital and reserves plus long-term capital, long-term loan capital. There's two formulas here. There's it there, okay. It's just those bullets. Right, so I'll write that one down, the second one, because we need the second one. Okay, so capital employed, the second formula, issued equity, capital, and reserves, plus long-term loan capital. Okay, that's what they gave you in the textbook. I'm just using exactly that. So that's just the formula. Alright, so now what am I going to do? Well, we were discussing points that they gave you in the question. So the question asked you for ROCE for 2015. Okay, what did we do? We wrote down the formula. Okay, then I'm looking at the formula. Do I have 2015's profit? No. Do I have 2015's capital employed? No. But I've got information that I can use to get 2015's amounts, but I need 2014's amounts. Does that make sense? Okay, so that's why I start with the green. Okay, so the green is what I actually want. Okay, 2014. So in 2014 we had 1 million. That was the equity and reserves. Okay, so let's do the working. ROCE brackets in 2014 equals 0.28, that's 28%. Okay, profit for the year before
so this is the working now, eh?
Interest, yes, and tax. Divided by. Do I know the capital employed? Yes, because 2014 they told you what the equity and reserves were. So divide by 1 million. That's 6 zeros, yes.
And this, where did you get this equity and reserves?
It's from the question. Yeah, the question said equity and reserves was 1 million, and the question said ROCE in 2014 was 28%. I just rewrote what we wrote at the top. Okay, obviously times 100 to get a percentage. Okay, so it's 28%, which is 0.28 as a decimal percent. Okay, maybe let's put the additional, let's put this in as well, 28%. Actually, let's leave the decimal there, that's fine. We'll still give you the same answer, because 28% is the same as 0.28. Okay, so can I work out the profit? Yes, therefore, calculate the missing figure. Okay, let's do the working here. Okay, so things need to change. This needs to go across, and then we need to times, not divide. Okay, so it'll be 0.28 times 1 million divided by 100. Okay, let's see what we get. 0.28 times 1 million divided by 100. Okay, calculator gives me 2,800. Let's check if that's correct though. Profit before, just put a note here. Okay, let's just redo the working just to put this amount. I think I left out 2 zeros. 2800. Okay, if I times it and I divide it, do I get that answer? Let's check. I get 0.28, which is times 100, which is 28%. Yeah, we have to add. So actually, I should put this here, 28%, because that's times 100. So 28%. Rather convert to a decimal afterwards. Okay, leave it as a percentage. Okay, so let's just remove that comma 0. Right, yeah, 280,000 would be better, because if we do the working again, just to check it, it will be 280,000 divided by that times 100. Let's check. Does that give me 28%? Paste. Yeah, 28%. Okay, so it's 280,000, just more zeros. Alright, so now do I have something? Yes, I do. What do I have? I should put this off. What do I have? I have the profit. Okay, so I know what the profit is now. We can highlight that. Okay, so now you know what the profit was when 2014. Okay, what is the profit going to be in 2015? Well, we just need to reread the question. The question gave you that statement. In 2015, profit from operations, again, we're assuming before interest and tax because they just said profit from operations, is 20%. Okay, so increase of 20%. So let's add 20% here. So this plus 20%, so times 1,2 gives you that. That's add 20%. Right, so if I add 20% to that, we would expect the profit from operations or profit before interest and tax to be 336 in 2015 because in 2014 it was that, and then they said an increase. Okay, what happened to the capital employed in 2015? It went up, right? How much did it go up by? 300,000 because you issued debentures. See, the formula says plus long-term loan capital. Long-term loan capital, that's debentures. So in 2015, capital employed would be equal to what it was in 2014, which was the 1 million, hey? We read that earlier, plus the 300,000. Okay, so 1,3 million. Okay, basically, in terms of equity. So I'm just applying what the question said. Okay, the question said that the company issued more debentures, so the capital employed is changing. Right, so now there's the profits, and there's the capital employed. Can I work out the ROCE?
Yeah.
Yes. Okay, so now we just plug it into the formula. Ooh. The formula. Okay, profit for the year, we can put in the amount that we just worked out. What was it? 336. The new capital employed, because things changed from last year, 1.3 million times 100 gives us a percentage. Let's check it. Oh, let's go back there. Okay. Equals, paste. Okay, 25.8462%. Do we have an option for 25.8462? Yes, D. If you round it off.
They said the answer C.
They went with C. Do they give workings for their calculations?
No.
No, then again I would query this one because they say unless see, because they're not specific, they just say profit from operations. Okay, so now again we need to relook and think about, well, what could they have done differently? Well, this is something they could have done differently. Remember, I assume this was before interest and tax. Okay, if I don't, then what am I going to do? I'm going to have to take out interest. Okay, so if we assume not before interest and tax, okay, then we must take off interest. Okay, but I want to confirm that. Let's just check profit from operations. Is profit for operations before or after? Let's check. Let's confirm that with the textbook. Okay, profit from operations, page 346. Page 346. Where's page 346? Here's page 346. Where's the profit before? 346. This is manufacturing overheads. Okay, there's a profit there. That's a gross profit. No, let's go back. Profit from operations. So another reference, 238. Let's check 238. Okay, so yeah, in the textbook, they show you profit from operations. Okay, we can reference this, page 238. Okay, so let's reference it, then that will actually confirm it. Okay, so if we assume not before interest and tax, assume before interest and tax, Oh, hold on. It is correct. The assume before interest and tax is right. I just haven't taken off the... No, actually, yeah, because it's not after tax, correct. Okay, so have a look. Page 238 shows profits from operations. Okay, if you look at this page, okay, where is the profit from operations? There. Do you see it?
Yeah.
Okay, is this profit from operations before or after tax?
Before.
Exactly. See, it's before the finance cost and it's before the tax. Okay, so what I'm thinking is they're probably taking off the interest, which you shouldn't, because that's the working.
But how would you take off the interest?
You'd have to subtract 10% the debenture. So see the interest here, 10%. 10% of 300,000. See, but that's not right, because look at page 238. Page 238, profit from operations is already before interest and tax. It's not after. If it was after, then you'd have to add back the interest. Okay. Right, let me make a note there. That one you can query. Okay, so asterisk here. Okay, and I'll even write down why. Okay, so this is the explanation, just to explain that topic. Right, so profit from operations, brackets, this is given in the question. Page 238 in the textbook shows profit from operations as being the profit before interest and tax. Okay, it's not after tax. Right, so that's already, so in a note, the profit from operations is the same as profit before interest and tax. Okay, it's exactly the same thing. Okay, that line item, profit from operations on page 238 is exactly the same as profit before interest and tax, because this line item is before the interest and before the tax. Okay, so there's no need to adjust this line item. Okay, and that's why I don't agree with that answer. Page 238. Okay, next question. 24.
Okay, 23. A manufacturer operates a bonus system. He provides the following information. Okay, so I don't know how to do this one. So
it's fine, let's do it together.
Okay. Output required from each worker is 175 units. Time allowed to complete output is 10.5 hours. Actual time worked by Fred is 7 hours.
Okay, so that's just background information regarding the production. Do you agree?
Yeah.
Okay, so what did they want? What did Fred earn for his output? Okay, so this is that earnings one.
The bonus is paid of 25% of the labor costs for time saved, in addition to the hourly rates of 8.7.
Yes, okay, so we're looking at this employee. So imagine employing this person. What's his name? Fred. Okay, so employee Fred. Right, Fred is working for the business. Let's write down what we know. Output required from each worker. So every worker must work the output required from each worker. I'm just going to put a bracket here, outputs. Okay, so Fred is a worker. Fred needs to produce 175 units. That's his job requirement. Okay, he's required to manufacture 175 units. Yeah, that's what he must do. Okay, then the time allowed to complete the output, the job, okay, is, which is given in the question, 10.5 hours, 10,5 hours. Alright, so that's the amount of time that he has. Okay, so he's only got a limited amount of time, 10.5 hours. In that time, he needs to produce 175 units. Okay, that's what they're saying.
But he actually produced in 7 hours.
Okay, so is he a good worker? Yes. Right, so Fred actually only needed 7 hours to manufacture those units. Hopefully they're still of good quality and all that, but that we won't discuss. Okay, that's a consideration.
Of 25% of labor costs for time saved.
Yes, okay, so a bonus, 25% bonus.
So what is labor cost?
Yeah, labor cost is what you pay the employees. Okay, bonus of the labor costs.
So how do we work out the labor cost?
They give it to you later. 25% bonus of the labor cost in brackets saved. That's important. Okay, at a rate of, what is the rate? 8,75. 8,75 per hour. Is that right?
So 25%
yes.
of 8.75.
No, the excess. Okay, see, in brackets, this is important. That's why I put that in bold. It's the labor cost saved. Okay, the labor cost saved. Right, so let's put a note. Normal employee. Okay, normal employee, how much time do they need? 10,5 hours. Multiply by, how much do they get paid? $8.75. $8.75. Okay, so the number of hours, 10.5 times 8.75 is 91,875 per employee. Right, that's a normal employee. Fred is a good employee. Fred only used 7 hours. So 7 times 8.75. Okay, so 7 hours, let's put that in, times 8.75. 7 times 8.75 gives us 61 for Fred. Okay, so obviously this is important and that's important because the difference is what was saved.
So doesn't he get paid for extra for completing it faster?
Yeah, he gets 25% of the 25% bonus of the labor cost saved.
He basically saved 3.5 hours. Because he did it in 7 hours.
Okay, so what answer did you get?
No, I'm just saying the saved hours is 3.5 hours.
Okay, you're looking at hours. Let's see if it works out. Let's just finish this and then we can go and look at that. The difference is what he saved. This minus that. Okay, he saved that. What is he going to get? Bonus times 25%. Okay, that's it. So I'm just going to take that. So he saved 30,6 times 25%, 0.25. Okay, which is that. So that's how much he saved. That's his bonus. Right, so what did you say? You want to work it out 3,5 times...
No, you finish your answer. Finish your answer.
Okay, so what did they ask for? What did Fred earn? So Fred would have earned this plus that. Okay, so Fred earns 661,25. No, that's how much he saved, and that's the bonus. Okay, just question here. Okay, obviously Fred did a better job. Do you agree?
Yeah.
Surely, if Fred worked the full time, he would have worked 10.5 hours, but he didn't. He worked less. Okay, so are we only going to pay him for the hours that he worked, or are we going to pay him the rate that he did? See, that's the question mark. See, so think about this. Okay, you've asked an employee to make 175 units. Okay, you expect a normal employee to use 10,5 hours. Okay, so 10,5 hours is how much you are going to pay for someone to manufacture 175 units. Right. If Fred is only going to take 7 hours to make this product, he's a good worker, right? Are we going to pay him The 91.85 or the 61.25? It's probably going to be the 61.25. Do you agree? See, that's the thing. So now, do you pay them for their task or do you pay them for their time? Okay, so the task was what? 175 units. Both employees did it. That employee did it, that employee did it as well. Obviously, Fred is saving you some money. Why? Because he's more effective. Okay, so the debate is, do you pay per task or do you pay per hour? I'm looking at per hour here because they just said that what did Fred earn on his 175 units? Right, so it would just be the 61.25 plus his bonus, 7 Rand, 625. Okay, assuming that they're not going to pay him the full task rate. Okay, because the task was 175, so 68.90.
Yeah.
Okay. Yeah, but that's that's assuming not paying for the task, just for the time, only for time. Okay.
Let me just write this down.
Yeah, so you're paying Fred for his time on his task. Yeah, because the task will still compete, whether he took 7 hours or 10.5, he still produced 175 units. Yeah, with management accounting, in reality, it's very specific to the type of business. Like obviously, we need to use the question to answer. Yeah, so key in the question was saved. That's why I did it this way. I don't know if you took the time into consideration, would you get the same answer? Maybe. Let's see. Just out of curiosity, it's possible. Let's just see. 3 comma. You can carry on. I'm just doing an extra working. What is the rate? 8.75. Let's see. That works out. No, it won't. See, 3.5 times 8.75 is already more than 7.65. You see that? Okay, because it's a percentage of the savings, yeah. Alright, so I would just do it this way. I wouldn't try to use the time. I mean, it's easy to understand. It's quite straightforward. Don't think it's necessary to look at a different method.
So is this the difference between these two?
Yeah, the difference is what was saved. Okay, so that's why normal employee, you would have paid them $91. Fred, you're only going to pay him 61. Fred made this 175 units in the same amount of time. Well, less amount of time.
So this bonus, what was that, the 3.5?
The bonus, so let's just read the question again. A bonus is paid for 25% of the labor cost for time saved. Okay,
so what did you do to get this calculation?
Yeah, so what is the labor cost for time saved?
30.265.
And what is his bonus? 25% of that.
So it was 30 times 25%.
Yeah, because it's that times that 25%. Okay, ready. Next one. What is that one? 23, 24. Right, 24 says, okay, that's theory, that we can answer quite quickly. You've already answered it, hey?
Yeah. Yeah, but they said B.
Okay, if it's theory, we can check it. Let's see.
So a potential investor looks at the financial statements for 4 companies. Their income statements all show the same level of revenue and profit for operations. The cost of purchasing inventory is increasing. Company 1 uses AVCO to value inventory.
So that's an average value of the cost of company.
Yeah.
Okay, that's all the inventory. That's in the inventory chapter.
Company 2 uses FIFO to value inventory. Company 3 uses absorption costing, and Company 4 uses marginal costing. What is the best underlying profitability? Which company should he select?
Okay, so let's go back to inventory.
I said 2 and 3, which was FIFO and absorption, but they went with 1 and 4, which was marginal and average.
Okay, let's see why. Because this is looking at management accounting relating to the cost. Yes. Okay, this was inventory cost, so that would have been the AB, the average. Let's go to that page. That will be a better reference. Okay, the AVCO, average weighted cost method, page 162 and 160. Okay, so let's go back to that page and see what the theory says. Okay, here's all the methods. Yeah, first in, first out, last in, last out, weighted average cost of value inventory. That's an AVCO. Right, so here they say the average cost of goods held is recalculated each time a new delivery of goods is received. Issues are then priced out of this weighted average cost, okay, because you're using an average, not the first in, first out, or last in, last out. Okay, what did the question ask for? The investor wishes to invest in a company with the best underlying profitability. Okay, so that's important. The investor wants the best profitability. Okay, so best profitability means what? More income, less expenses. Do you agree? Okay, so they want to invest in a company with the most profitability. Which company should he select? Okay, so the only thing different with company A, B, C, D, or 1, 2, 3, 4, let's write that down, is their method for measuring inventory. That's all. Okay, so the inventory measurement system. Right, so number 1 was the average. Okay, weighted average. I'm going to write that down. Or let's write the whole thing. AVCO. Okay, page 160. Okay, 2 was FIFO. FIFO. First in, first out. 3 was absorption costing. And then 4 was marginal costing. Okay, so that's what I've got. I need to know what effect does that system have on profitability. So income and expenses, profitability. Okay, so that's the big question. So let's go back and get the answer. Right, so just to revise FIFO. FIFO, as the name suggests, this method assumes that the first goods received by the business will be the first ones to be delivered to the customer. Okay, are prices going up or down? What did they say in the question? That we need to know. Increasing. Okay, so that's also something else to consider.
The income statements are also standard the revenue and profits of operations. The cost of purchasing inventory is increasing.
Yes, so cost for inventory are rising. Okay, so let's look at FIFO. FIFO. Right, FIFO is the first inventory that comes in is the first inventory that goes out. Okay, so if we buy now for 10. Okay, we're gonna buy later for 20. Okay, so now if I'm looking at costs, remember FIFO is the cost of inventory bought. So if I'm buying for 10 now and I'm going to be buying for 20 later, okay, my costs first is low, my costs later are high. Okay, so you're looking at first in, first out. Okay, so first in, first out means the items we buy today are the items we're going to sell in the future. Okay, so if I buy items later, they're going to cost more. So if I'm looking at the effect on profitability, okay, the higher costs are going to be used when? Later or now? No, the higher costs are used later because first in is what goes out first. Do you agree? So whatever I buy now is what I sell. Whatever I buy now is what I sell. Whatever I buy now is what I sell. Okay, so that means that the lower costs are always attached to the sale. Okay, so what is the effect on profitability? Well, the FIFO would actually be the best way because what you sell first is what you sell. What you buy first is what you sell first. Okay, first in, first out. Okay, so what I buy is what I sell. Okay, with the other one, LIFO, did they give LIFO? No, they didn't give LIFO.
They gave
no LIFO. Yeah, they gave the average one. Okay, so the average one looks at the average of the cost in the past and now. Okay, so let's discuss that one. ABCO. Okay, same scenario. We buy 10, we buy 20. Okay, what are we going to do? We're going to use the average, which is 15, basically. 10 plus 20 is 30, divided by 2 is 15. Do you agree? Mm-hmm. Okay, so that's looking at the average cost. So if we are going to be buying items that cost more later, okay, in terms of FIFO, when do I sell those items? I sell the items first. So whatever I buy today, I sell whenever I sell it. That's the first item that go out. First in, first out. Here we've got the average. Okay, so if I'm buying items that are more expensive, now, am I selling that item at the same cost? No, I'm selling those items at a cost which is the average.
Yeah.
Okay, so is the 15 less than the 20?
Yeah.
Yes, so you're actually buying goods at a cost of 20 and you're selling them for 15. Are the costs more or less?
Less.
The costs are less, so the profit is more. Okay, so that's why. So I agree with the first one, number one so far. Okay, why? Because of this. Okay, profitability increases because the average is used. Okay, so yes, I agree with one so far. Let's look at the last two. Okay, so we can say increase here. Answer that one. Increase. Okay, so now we're going to revise absorption. That goes to management accounting. Okay, so theory-wise, absorption costing 21. Okay, here's absorption costing. In this chapter, where's the definition for it? We need it. Definition. Here, uses of absorption costing there. Calculation of profits. Okay, yeah, that's the costing. Okay, so here, the total cost of producing goods is necessary when calculating the selling price. We know that. Okay, because you need to price your goods based on how much it costs. Right, so if I'm using the absorption costing, there, apportionment of absorption overheads is the process by which some overhead costs are charged to cost centers on some rational basis because they cannot be directly attributed to a particular cost center. When all overhead costs have been apportioned to the cost center, the total has to be charged to specific units of production. Okay, so let's revise that. Absorption costing. Okay, we read the theory again. What do? You absorb costs as and when you produce. Do you agree? Okay, that's what they said. You absorb in the process of production. So absorption costing relates to the management accounting where you're taking those costs of production into consideration and you're apportioning the overheads. Okay, overheads, rent, insurance, maybe those type of things, like costs that we need to apportion. Okay, so if we're absorbing the cost that we produce, then that's accurate. It's an accurate measure of costs. Why? Because whatever you spend is what you recover. You absorb the costs. Okay, so would that affect the profitability? Well, if I spend more later, I'm going to allocate more costs. If I spend less later, I'm going to allocate less costs. So the costs there would be what the costs are in reality. So there wouldn't be an effect on profitability, but the prices are rising. So if the prices are rising, the cost will increase. The cost will increase as well, and you would absorb more. Okay, so if you absorb more, profit will be less, effectively. Okay, less profits. Okay, from a theory point of view in terms of the system. Okay, less profits. Okay, was that out or in? Out. Okay, the last one was marginal. Okay, so let's see why is that one correct. Let's have a look. Okay, just to revise theory, marginal, M. Where is it? Here, M, marginal. Marginal costing, 301. Okay, here's 301. There's marginal costing. Marginal costing says, is defined by SEMA as the cost of one unit of a product or service which would be avoided if the unit were not produced or provided. That's what they said. Marginal costing is a decision-making technique used by management accounts. It is based on the extra costs, see the additional costs incurred and the extra revenue generated by the production and sale of an additional unit of output. Marginal costing makes a clear distinction between fixed and variable costs. When using marginal costing, no attempt is made to allocate or apportion any fixed cost incurred by cost centers or cost units. So that would be motivation. See, no attempt is made to allocate or apportion any fixed incurred by cost centers or cost units. So what does that mean? You're not taking those additional fixed costs into consideration. So if you're not taking, so based on theory on page 301, then I do agree with that. Okay. All right, page 301. All right, so that one's fine. Question 25. Theory again, looks like it's.
A company is classifying its costs. It discovers that for any level of output between 10,000 and 15,000 units, the freight cost per unit is always the same figure of $2 per unit. Which type of cost is an example?
Yeah, so freight cost would be, they said fixed, eh? That's what they said.
So what is freight costs?
Freight cost is just transport costs. Yeah, but the key in the question, they said, let's read it again. It discovers that for any level of output between 10,000 and 15,000 units, the freight cost per unit is always the same. So there's the giveaway, always the same. So basically, as long as between 10,000 and 5,000 units, brackets fixed.
You said 15,000.
Yeah, 10 and 15,000. That's what they said, hey? Yeah, between 10 and 15. Okay, so between 10 and 15, those costs are fixed. Obviously, if those costs are less than 10, in terms of units, if it was less than 10, those costs aren't fixed. If it was more than 15, those costs aren't fixed. Do you agree? Okay, so we can assume that it would be variable, asterisk, variable if less than 10 or more than 15. Right, because they say it's only fixed for that scope. Okay, so what does the question ask for? Of which type of cost is this an example of? I would go with semi-fixed or semi-variable. Semi-variable cost Semi-variable means it varies, but not over that. So now see, is the question asking, are they asking only from 10,000 to 15, or are they asking just in general? If it's in general, then it would be semi-fixed. See, okay, if we look at...
Okay, but can you explain to me why they said variable costs? Because their answer was D, variable costs.
No, I would disagree. I would go with semi-variable, or semi-fixed. It's the same thing. Semi-variable, semi-fixed. Semi-variable means it kind of varies, or semi-fixed kind of stays the same. So semi-fixed. Okay, why do I say that? Because if units are 0 to 10,000, brackets variable. Okay, for units 10,000 to 15,000, it's clearly fixed. And then for above 15,000 units, it's variable. Okay, because they don't say it's fixed for those things. They say it's only fixed between 10,000 and 15 units. Okay, so you can clearly see they talk about the overall scope of the production. Okay, if units are produced less than 10, variable, more than 15, variable. If it's between 10 and 15, it's fixed. Okay, so the costs would be semi-variable or semi-fixed. So I would have actually chosen, you went with A. I would have gone with B, semi-variable costs. Okay, you said they've gone with variable costs.
Okay.
If they don't specify why, then you can query it, because the problem with the question, there's nothing in the question that says this is only variable. They said it's a freight cost per unit is always the same, 2 and per unit. See, but it's between 10 and 15. So I agree with you, it is fixed, but fixed only between 10 and 15. So if the question said, what type of cost do you have if we're looking at production between 10 and 15? Fixed cost would be 100% correct. Agreed? Because that's what they said in the question. Right? Okay, so these are the things that you can query, because I don't have the answer. I didn't set the paper. I'm just giving you the information and the answer based on the theory. Okay, I can go back to all those pages and we can get a reference for semi-variable cost. Let's go.
It's okay, I don't want to waste time because it doesn't matter anyways. When does under-absorption of overheads occur?
That's theory.
So I said B1 and 4, which was actual expenditures less than budgeted and production is higher than planned. They said 2 and 3, which was actual expenditures more than budgeted and production is lower than planned.
Okay, so that needs to be supported by theory. Let's go and get the textbook answer, because we can't argue with the textbook. Okay. Right, so under absorption of overheads, that's under absorption. So let's find that under absorption. Yes, under absorption. So U. Here, unrealized, under cost, unlimited. Okay, they didn't give a specific reference for that. So let's just go absorption then, and then we can find the under and over absorption. Okay, so absorption, the absorption costing, here they wanted the overheads. Okay, so absorption of overheads. Absorption, there's the semi-variable costing actually, the overheads, 289. Okay, so absorption of overheads, page 289. 289, here's it. Okay, we saw this earlier actually there. Allocation of cost, overheads. Here they said, okay, that's the theory related to overheads. We need the over and absorption. That we read again, that was fine. That was overheads, absorption overheads. Here, page 297. Right, that's the textbook reference that would motivate the answer. Okay, so here, over absorption and under absorption of overheads. It's given here. There will be an under recovery of overheads, or there will be an over recovery of overheads. So which one are they asking you about? When does under absorption of overheads occur? So when does it occur? Under absorption, so this one, under absorption. So here's the theory. Let's read the options. Okay, let's read this first, then we can go back to the options. Overhead recovery rates are based on predictions of future level of activity and predicted budgeted levels of overhead expenditure. If the actual level of activity is equal to that budgeted and actual expenditure on overheads is equal to budgeted expenditure, then the expenditure on overheads will be recovered exactly. If the actual level of activity is less than the budgeted level and spending on overheads is equal to the predicted level, then the actual overheads will not be recovered. There will be an under recovery overheads. There's the theory. Now we just choose the right options. Okay, so you said they went with?
C.
2 and 3. Okay, so actual expenditure is more than budgeted. Did they say that in here? If the actual level of activity is less than budgeted. See, I disagree. Page 297. It's exactly in the textbook. Okay, read that.
I know, I'm not arguing with you.
Okay, so it's not my fault that the answer that you have is not in line with what you think it is, because okay, let me read it again. If the actual level of activity is less than the budgeted, here, actual expenditure is more than the budget. That's clearly wrong. It's lower than. Actual is less than the budgeted, so you are correct. Your answer of B is correct. Okay, you probably remembered it or you went to the textbook. Right, so well done. That is correct based on the theory. Right, so this you would query. Errata, tell them to read page 297. Your answer is correct. Question 27.
The following information is available in respect of Department 1. Direct labor hours, machine hours, overheads to be apportioned to Department 1. The company has been asked to quote for an order. The expected time taken in Department 1 will be 4 direct labor hours and 7 machine hours.
Yeah, so that's just a quotation. We did one similar previously when we looked at the other two.
Should be charged to the order as it passes through Department 1. Yeah,
100%. Okay, so all we need is just the information. Okay, so direct labor hours. We know actual and forecasted. So actual is what actually happens. Forecast is what's budgeted. Do you agree?
Yeah.
Okay, so that's the theory. Let's go through that as we go through these questions. Okay, 40,000, 45. Okay, then they tell you that the machine hours. Machine hours, 12. 10. Okay, then they said overheads to be apportioned to Department 1. Okay, so that means you've got a portion of the overhead that must be allocated to a separate department. Okay, based on those pieces of information. Okay, so overheads to be allocated to Department 1. Department 1, what is it? 90,000. Department 1, brackets, 90,000. Close brackets. Okay, the company has been asked to quote for an order. The expected time taken in Department 1 will be 4 direct labor hours. Okay, so now let's write that down. Department 1, we need to work this out. So, Department 1. What does Department 1 use? It uses direct labor hours and it uses 4. And 7 machine hours. Okay, and then machine hours, it uses 7. Okay, that was what the question gave us. Okay, how much overhead should be charged to the order as it passes through Department 1? Okay, so in other words, they want you to allocate that overhead to be allocated to Department 1, 9,000. Okay, and that's based on what? An absorption rate, because Department 1 is going to use 4 labor hours and 7 machine hours. Okay, so if we look at the forecast is what was budgeted. Do you agree? Okay, so we are going to have to look at the rate. So the absorption rate, okay, the absorption rate here would be, that's the budgeted labor hours, and that was the cost. Right, so we need to know what the cost per, do they give you the cost here? This actual, is that hours or cost? What would you say? I would think hours. Do you agree? And I would think this is hours as well, right? Okay, so they don't give you the cost, so you can't have a rate here. So it's a little bit different to the other one we looked at, because the other one we worked out a per unit rates or per hour rates. Per hour rate. That was when we looked at it at a different quotation. So this one is slightly different. So now we need to look at it again. Okay, so the company asked for a quote. The expected time taken in department 1 will be 4 direct labor hours and 7 machine hours. So 4 direct labor hours and 7 machine hours. How much overhead should be charged to the order as it passes through department 1? So they're saying it's 4 labor hours. We need a rate. So the overheads, that was allocated to the department based on the forecast. Okay, so let's do this. Total hours. So if we look at the labor and the machine hours, total hours is 50,000. Okay, so 50,000 is the forecasted budget, 40 which was for the direct labor, and then 10 for the machine. Okay, this 90,000 is overhead. They don't specify if that is how much of it is labor and how much of it is machine. That's what they don't do. Okay, because that's what I'm looking for. I'm looking for how much is the labor cost on its own, and then how much is the machine cost on its own. Because then I can work out a rate for this one and for that one, like we've seen in other questions. So this one's a little bit different because they only give you one value. They give you 90,000. That's all they give you. Right. So my only option then would be to take the 90,000 and to use the total hours that are being used. Okay, which is 50,000. So divided by 90,000 costs or overheads. Let's use that word. Overheads divided by the 50,000 hours. Okay, so that will give me a rate based on the information. So 90 divided by 50. Okay, so that's per hour, because you need an absorption rate. Okay, per hour rate. Right, and then I would apply that to all of these. Okay, I would just copy that here and there. Okay, so 4 hours times that rate. 7 hours times that rate. Okay, so let's do the working. 4 times 1.8. And then 7 times 1.8. Only because they didn't specify how much each of them were separately. And that's how we've got to use the total. Okay, let's see if we get something that's in line with what they've got. If not, then we can always see if we can try and get it a different way. Okay, let's get 7.2 for that one, and 7 times 8 for that one. Okay, so is there a 19.0? See, there isn't. Yeah, this one I would have to check. Which one did they go with? See, because that would be the rate that I would go with. B, which is 9. So $9. This would be 19. 7 plus 12. Okay, 4 direct labor hours, 7 machine hours. Let's see. This is overhead allocated 90,000. Yeah, you would need to know what the individual costs are. That's not given. See, there's the question mark here. Okay, so like, what are the costs? Because do you agree, labor hours and machine hours are completely different.
Yeah.
Okay, so we would need more information here. Okay.
A business manufactures a single product. The following information is available: selling price per unit, variable cost per unit, total fixed costs, and profit for the year. How many units must be sold to achieve the same profit for next year?
Okay, so same profit for next year, so we need to look at this year, then next year. Okay, so this year, what is the profit? That's what you need to work out.
20,000.
Okay, did they give that to you, hey?
Yeah.
Okay, perfect. So 20,000 is the profit. So no need to calculate it actually. Profit given. Right, next year, that's what they want. They want to know what the profit is here. Same profit, eh? Getting the same profits. Okay, so if we get the same profit, the profit will be 20,000 next year as well. Okay, so how many units must they sell? Yeah, so estimated cost next year, selling price per unit next year. So next year's selling price is how much? 25. This is more a maths question than a accounting question. Variable cost? 17.
Fixed cost 84,000.
Fixed costs 84,000. Okay, so that's what they gave you. Alright, so I want to get the same profit. Okay, so revenue minus variable costs minus fixed costs. Okay, there's the formula to get profit, obviously. Alright, let's put that in. Profit equals. Okay, so it's a maths equation. 20,000 equals. Revenue would be price times quantity, which we don't know. So it'll be 25x brackets minus variable costs would be 17x minus fixed cost of 84. Okay, there's it. Solve for x. Yes, you solve for x. Okay, so x is 20,000 plus 84 equals 25 minus 7 is 8x.
25 minus 17.
17, yeah. 25 minus 17 is 8. Okay, so 20,000 plus 84,000 is 104, which is equal to 8x. Therefore, x is the difference. This divided by 8. Okay, so we would have to sell 30,000 units.
Yeah, got that. That's D.
Okay, good.
Okay, so you just write that quickly down.
Yeah, so that's just the word sum. That's like that's word sums that they give you in grade 8. Okay, to solve for x.
Do you want to look at the next questions?
Yeah. That's also a maths question. Right.
Just like that. One more question is this? 28.
Yeah. Ready, okay. Right, so that one is also maths again. We just need to put in the values. So copy paste the formula, profit equals revenue minus variable cost. Okay, in this question, the profit was 600,000. So 600,000 equals, let me just check the values here. They wanted the selling price. So they gave you the 50,000 units. Now the X is the price that you're selling it for. So the number of units, 50,000 units, times X, which is the selling price, minus variable cost. So they give that to you? Yes, 60 Rand or $60 a unit. 60 times 50,000. Minus fixed cost, they give that to you? Yes, they do. Okay, so there's it there. That's the math equation. Solve for X. Let's see what we get. Okay, so take everything else to the left. Can you work out what 60,000? What is 60,000 times 50? 60 times 50,000. What is that? 60 times? Oh, sorry, too many zeros. Times 50. Times 15. So 50,000. 60 times 50,000. There we go. Okay. So it's 3 million. Okay. So 600,000. Equals 50,000x minus 3 million minus 400,000. Okay, so take everything to the one side. So 400 is going to go that side, it's going to be plus, so that will be 4 million. 4 million equals 50,000x. Therefore, x equals 4 million divided by 5, 50,000. Gives me 80. I get 80. You got 72. Okay. Because let's check it. 80 times 50,000. Okay, that's the selling price. That's the revenue. Minus open brackets. 60 is the variable cost times 50,000, close brackets, minus the fixed cost of 400,000. Gives you, yep, 600,000. It's definitely 80. Okay, just solve for X. Then the last one's theory. Okay, we'll look at it just now, just initial brackets.
Okay.
Alright, so the last one talks about a shortage of direct materials. Okay, so question 30, shortage of direct materials. Okay, so if there's a shortage of direct materials, that means that you are going to be producing products taking that into consideration. So number one, which product will it manufacture first? The one with the highest contribution per unit. Let's revise. Contribution per unit means what? What does that mean? Contribution to you per unit.
How much will you contribute?
The profit, the additional. So that means additional profit or benefits derived. Okay, so I'm definitely going to be producing the one with the highest contribution per unit. That makes sense. And they say of limiting factor. So that of limiting factor. Okay, because you've got the word limiting factor there, the direct material would be a limiting factor. Right, so I like the way that's worded, so that one looks good. B, the one with the highest demand. No, okay, you wouldn't produce something that has the highest demand. Well, if this was an economics question, then you probably would, because that would be different. Okay, C, the one with the lowest quantity of total direct materials used. You could consider doing that, but if you do that, maybe it's going to be the product that doesn't provide the most profit. So you went with C, but I think A would be better because it's looking at the contribution, looking at the limiting factor in consideration. The one with the lowest variable cost, no, I would go with A here.
Okay.
Right, and that's that past paper. Good.
Now just did a few questions from these ones.
Yeah, let's check. Number?
May, June 2016.
Okay.
So I've got the memory on the left first mark. Or do you want to go through the most?
Mark for once.
You don't agree with the memo, so I don't know what to do.
Not always. There are instances where, and I say why I don't agree with the memo. It's not because I'm just being difficult. I disagree with the memo because of references in the textbook. Okay. All right.